Earlier this year, Nelson Peltz was in a proxy fight in order to get a board seat for the Walt Disney Company. Bob Iger managed to fend him off, but not without some damage to the company. All of the announcements that were done to keep him away, like Venue Sports or a $1.5 billion investment in Fortnite, seem to have had their effect, and then that effect might have gone away. And now a major financial institution has downgraded Disney stock. Let's talk about what that means here on That Park Place. Hello, I am Jonas J. Campbell, an investigative reporter for That Park Place, and here with me today is the Walt Disney Company stock price. I wanted to talk about this for a moment because we try not to focus too much on the stock price here on the channel, or not as often as we're thinking about it. It's something that's kind of always in the background. We're examining what is going on with the company. I want to talk about the fact that this right here, this moment in March of 2021, by the way, about right here, that's where Miss Gina Carano was let go by Lucasfilm and let go with a very nasty letter. And then they had about a 1 month mark here where that $200 a share point was fresh in everybody's mind. Bob Chapek was the CEO of the company. Bob Iger was the executive chairman. Everybody was happy. And then and there we have a massive decline. Over on That Park Place Live, we talked about this stock drop and the downgrade on the stock. Right now, we're in a little moment right here. If you want to look, there's a little small climb that's going on right here, and that's really good if you're in for temporary gains on the Walt Disney Company. But this decline right here, I've often theorized on why this happened, or rather, we should say why this gain happened right here. This is about the launch of Disney Plus in 2019. Down here and then all the way up here. I think we have a company that rebranded itself from a theme park company to a tech company. We started seeing those Netflix numbers, and I mean Netflix numbers in the stock price. Obviously, nowhere near a Netflix as far as Disney Plus goes. That's a failing streaming service if anybody doesn't understand that. So as we see this decline, there's a question going on of, is the company failing or is the company just right-sizing? This is the question that I would like to contemplate with our guests here on That Park Place Live. Let's get to the panel. The thing that we keep coming back to here, this was actually very shocking to me because I was watching the Disney stock price go up very slowly, and we always keep an eye on it. We don't try to report on it daily because the Disney stock going up by $1 here or there is usually not a story unless it's hitting one of those boundary marks like a $90 or a $75 or an $80. If it ever got below 80, which it has gotten below 80. But this was surprising news for me. Disney is cut at Raymond James as several headwinds to stock range bound, which is basically they're saying that the stock has been downgraded. Raymond James downgraded Disney from outperform to market perform in a note Tuesday. It took them long enough, citing several headwinds, particularly within the parks division, that are expected to keep the stock in a range bound pattern over the next 12 to 18 months. That would actually be a relief, I think, for this company to stay within a range bound pattern because their beta, otherwise known as their correlation to the market, has been not great. Despite a recent 12% bounce, analysts believe Disney is unlikely to outperform meaningfully in the near term. Parks are under pressure, Raymond James noted, stressing that park attendance and pricing power are slowing down. Vash, I think you've got a story to add in there. The one from Scott Gustin. Following a post-COVID surge, they said demand is now moderating. They said demand moderation, otherwise known as softening of the parks, otherwise known as people are not showing up to the parks. Demand moderation means they can't move the product. As consumers digest price increases from the last 4 years, this is such a euphemistic way of saying this. Following a post-COVID surge, they said demand is now moderating as consumers digest price increases from the last 4 years. This is corporate speak, and I hate it. I understand why they're saying it this way. Simply stated, they had a lot of people come in because of COVID. All of that has died off now, and demand is lower than it was.
Yes.
I don't understand why they say it in the way that they do, other than they're trying to hide the ball. They're trying to soften it so that people don't understand what they're saying immediately. Furthermore, Disney is said to be facing increased competition, particularly with the launch of Universal's Epic Universe in Orlando next year, a key market for Disney. This competition is expected to be a major headwind for who? Are we saying it's a major headwind for Universal Epic Universe? That would be the natural statement there. Disney, and I don't think they're completely wrong about this, has said that people coming to Epic Universe, if there are people coming to the area that would not have come otherwise, that will be a boost to Disney unless they show up. And this is this is really where it comes down to it. If people show up for that first time in a long time, which we hear about this every single day, of people showing up to the parks, seeing the state that they are in compared to what they expect them to be in, the image that Disney puts in their minds of what a Disney park looks like, they see that it is no longer of that quality, and they say, if I'm paying this much money, I want everything to work. I don't want to be walking through cobwebs. I don't want to look up the streetlights and see spider webs all over the place, which that's a story we've covered here on That Park Place in the past. Raymond James highlighted 3 specific challenges affecting Disney parks: the Paris Olympics pulling attendance away from Disneyland Paris.
Lies.
That's reading straight from Disney copy, though. I don't believe that. A typhoon that temporarily closed Shanghai Disney, and the impact of a recent major hurricane on Walt Disney World in Orlando. Really? They think the hurricane shut them down for more than an evening? That would affect ticket sales for Oogie Boogie Bash. And Universal would be seeing the same because they had to cancel Halloween Horror Nights, which I think Halloween Horror Nights pretty popular. So why would that not be listed as a market thing as opposed to a Disney specific thing? Doesn't make sense to me.
Yeah, especially when you have a lot of international visitation to a place like Walt Disney World in which people might not be affected by those hurricanes. It might be a little bit more pronounced if you're talking about a locals park. But Walt Disney World doesn't actually fit that category. Yeah, Mickey's not so scary. Tickets might be impacted, but only for that single night, like you said, Jonas. Otherwise, operations haven't been impacted all that much. I haven't looked at sales around this time and kept track of wait times and so forth to really do some crowd analysis. But I mean, the holiday season is coming up. That should be a decent quarter for them, even though Hugh Johnston has said that it's going to be soft for the upcoming quarters. And we have evidence that Disney understands that these quarters are going to be soft with some of the discounting going on.
There is one thing that I definitely agree with Raymond James on here. They also noted that while Disney's 3 new cruise ships expected by the end of 2025 will contribute to growth, they will bring significant capital expenditures that will pressure free cash flow in the near term. I think that's probably $1.5 to $2 billion, which that is a lot of money, but considering what they're going to make on those cruise ships, they probably will make their money back. They're going to start to try to test the limits on what they can do with the cruise ships. Hopefully, the cruise ships will not suffer the same symptoms that the parks are by lowering in quality. We are hearing from some people that the cruise ships have lowered in quality. I haven't seen widespread indications of that, just anecdotal indications for now. There's also some weird things going on with the cruise ships, like we covered here, flies all over the food because they didn't quite set up the systems they were supposed to set up, ridiculously long piers because they say it's for ecological reasons, but there are ways to mitigate that by not putting a half a mile walk on guests right off the bat. But those cruise ships are the future of the company because it's the only area where I see significant growth for them. There's some mention of ESPN costing more, yes, but that's just going to end up in another streaming land grab to try to get more people to sign up for an ESPN streaming service, which is going to be probably priced in the $50 to $60, maybe even $70 range. I don't know what that'll cost, but I understand where Raymond James is coming. Where they're coming from on this, and I agree with them that Disney stock is not where it should be, and they've lowered in price because of this.
Thanks for watching That Park Place News. For more information, consider checking out www.thatparkplace.com. And don't forget to subscribe, share, like, and send this out on your favorite social media accounts.